Welcome to this week's edition of the 6-5. I'm Patrick Moorhead with More Insights and Strategy, and I'm joined by my esteemed co-host, Daniel Newman with Futurum Research. Daniel, how are you, my friend?
I'm great, buddy. It's always great when we're having an opportunity to get these shows in every single week, bringing them to our awesome community here on the 6-5 podcast, our awesome growing community of watchers and listeners. And I say watchers because if you're a listener, make sure you go ahead and check out our YouTube. Not to do the quick sell straight away, but Pat, we've been doing this as a video show on the 6-5 Live television now. And so for everybody out there that wants to kind of catch, the interaction in a new way, or people that like video, hey, we're there now.
Yeah, it is fun, Dana, to go back. I look at the first episode that we did live. I didn't even have anything behind me. I had a box. I think I took a shower that day, but it's dark, you're dark. And as each video has progressed, the video quality is getting better. So I'm hoping we're going to hit a new milestone here. But for those who aren't familiar with the 6-5, we choose 6 handpicked topics that we're going to cover for 5 minutes each. We don't do news. We pontificate and analyze the news. The other thing I want to point out, because we do talk about earnings and publicly traded companies, is don't use any of this information for your investment purposes. If you're a day trader, you're going long, just don't do this. Don't take it as investment advice. So let's get started here. So first off, IBM did a deal with, I hope I say this correctly, Caixa Bank. And Daniel, some pretty big news out of the IBM Cloud Group.
Yeah, and I don't know for 100% certain if we would ever say it correct, whether it's Caixa or Caixa Bank, but it is one of the largest banks in Spain and Portugal, and it serves over 15.5 million customers. And a lot of people heard a lot about IBM's financial services ready public cloud and the deal the company did with Bank of America. And this isn't the same as that, but Pat, you and I have been tracking very closely what IBM is doing in the cloud. And look, the company is a ways behind in terms of market size and share from AWS and Microsoft Azure. But that third spot, that fight for the third spot, is a legitimate opportunity, and IBM is in a good position. And I've been really bullish. So the move itself, and I'll just touch on this quickly, is essentially Caixa Bank leveraging IBM's cloud packs and running its Red Hat OpenShift to be able to manage workloads and applications across its infrastructure. I point that out because, first of all, a lot of people wondered about the $34 billion acquisition of Red Hat. That move is proving every day for IBM to have been a better and better move. As parts of the business like power continue to struggle, the cloud and the Red Hat component of the business continues to be its growth engine, and it will be into the future as hybrid architecture and cloud native becomes a more important part of every business's strategy and the next generation architecture for enterprise applications. The second thing I want to point out here is they're leveraging IBM's AI. So behind it, they're going to leverage AI to further innovate. And Caixa is even committed to using the company's quantum technology in time to deliver new services, enhance security, and build for the bank of the future. My last thought on this, Pat, is IBM needs a story of differentiation. Vertical market and enterprise focus is where it's at. The company isn't going to be winning the Netflix deals. It's not going to be winning, of course, it's not going to win the Walmart deals. It's just not where IBM is positioned. But where it is positioned really well is to specialize in verticals like finance and become, use the Bank of America relationship, use the financial services public ready cloud, go get the rest of the banks, go get more big banks, and also take this into healthcare. Take this into manufacturing, take this into other verticals and show the ability to deliver these packs, deliver scale, leverage Red Hat OpenShift, and take advantage of multi-cloud to get your feet in the door in some other deals that maybe AWS, Azure, Google are primary, but still playing a role using the power of OpenShift. So that's my take on Caixa, Pat.
Yeah, those are good insights, Daniel. And I've written a couple notes on their financial services cloud. And if there's one area that I know that you can trust IBM, it's in financial. And if you have a credit card, which I'm certain everybody who's listening does, they process most of the credit card transactions on the planet. And there's a lot of reasons that they get that business. One of them is that it's secure. The other thing is that their architecture is takes advantage of throughput computing as opposed to other types of computing. And it just makes sense. Like you, Daniel, I do want to see them get into vertical because first off, the IaaS homogenous type of wins, I think are coming to an end, and we're getting to the other 80% of applications that aren't even in the cloud today. So let's move on to the next topic, and we're shifting a big gear shift into Amazon. If you've been following things with Amazon, I say it's fun to pick on them, right? They're not only are they most valuable company, they have the richest CEO out there. And the latest thing to pop up here is that they're going to be called before Congress to talk about how they do their store branded retail products. And in the industry, we call this private label. Now, I wrote an article on Forbes going through some of the debate points. And one thing is that, it's a huge business. Well, the fact is only 1% of Amazon's sales are private label. Walmart, on the other hand, 15%. The other thought is, it's high R&D products, right? This has to do more with Amazon Echoes and spots than other things. But the funny part of it is most of their sales are in family-related items like groceries, garbage bags, and things like that. But the one thing that Congress really wanted to know about is somehow it became bad for retailers to use their branded sales data to determine what their private brands should be. A little problem with that. First of all, is retailers have been doing this for 100 years. And the biggest retailers out there, Walmart, Target, Kroger, Costco, does the same thing. So, my final paragraph is, while I know it's fun to use Amazon as a punching bag, how about investigating Walmart? That's 45 times more, has higher probability to do this private label than anybody else. And the funny part is even on a raw revenue, Walmart's still twice the size of Amazon.
Yeah, I was looking through your piece, and I haven't tracked this quite as closely as you have, but I feel like Amazon is just one of the companies right now that people are looking for an excuse to be mad at. The pandemic didn't slow the company down. In fact, it accelerated all of its businesses. Its relevance became more understated, if anything, and as people were confined to their homes for a long period of time, they were able to extract extraordinary value from the platform. The company continues to win deals. It's become the biggest player in the cloud. It's become the biggest provider of home and everyday goods. It's become a search engine for basically shopping on the internet. And I think anytime that level of success takes place, people are going to be disappointed about it. So my thought process here, Pat, is with 1%. It's just not a big enough number. I mean, Costco, look at that. It's 20 times more private label. And by the way, growing up, Pat, I've been eating private label cheese, private label cereal, private label soda my whole life. It's always been a vehicle for retailers to augment sales, drive higher levels of margin, and sell products where people are looking for additional value. Why would the biggest retailer on the planet not want to play in that space? And Amazon has no reason to be scrutinized any more than any of the other companies. I think that's the key. If you're going to scrutinize Amazon, you can't just ignore the rest of the companies on the list. And it sounds like that's what's going on. And it's not only the wrong approach, it's a waste of resources.
Yeah, and I don't know this for certain. Maybe is it that the other retailers just have bigger lobbyists, but we'll have to see here. Let's move on to our next topic here, Daniel, and that is a Bloomberg report that says Apple is going to dump Intel for its microprocessors that go into Mac lines. Obviously, looked like a leak to me. But it's funny. This is one of these. I call it the worst kept secrets out there, and it's so funny. Right around every time Intel had to negotiate and do a 2-year contract with Apple, there was this mythical processor that came out. But I actually do believe this time they will. Some interesting points, though. The chief architects who worked on this part actually have left Apple and are at Nuvia right now, and Apple's suing that company for IP, which I find a little bit comical. But the second thing is that these chips, because the Apple language is on x86, they're going to have to speak the ARM language. So as a developer, you're either going to have to recompile or rewrite your applications, or there's going to be some level of translation, some overhead that goes into this. And I'm sure at WWDC, we're going to see cherry-picked and optimized applications for what things could be. I'm not saying that's bad. I'm just saying that I hope everybody asks questions, because to be honest with you, I'm unclear on the benefit to the developer, unclear the benefit to the end user. And I absolutely know the benefit to Apple is them making more money. But that's not a crime. There's nothing wrong with that. But I hope that gets analyzed if this does end up being true.
Yeah, Pat, I spent some time reviewing this. First of all, I read your tweet and it's some great insights. This is the worst kept secret. This was a article that was written 6 months ago and it was discussed. This was an article that was written a year ago. This article was written before Intel was ready to sell its mobile business to Apple. And so you picked on some things that caught my attention, but let me just give you a quick rundown of where I sit with this deal. First of all, non-starter. Intel has been preparing for this for 2 years. Intel has known this is coming, and Intel has been diversifying itself into a $300 billion TAM inside the data center, and that's where its efforts been each and every quarter. Does that mean losing an Apple logo relationship is going to not be damning or not maybe cause a stock to drop a couple times when that news breaks? No, they're going to deal with that. But the company's already been redirecting its effort into other pieces of the business outside of the PC. And remember, Mac's only about 12% of sales for PCs here in the US, and it's less outside of the US. It's not a really giant number. Bottom line is ARM architecture is going to be a slight threat. We've seen Microsoft go to it. We've seen Lenovo go to it. We've seen, what was the third? Samsung has put out ARM based, and this is going to happen in different capacities. I think AMD is a bigger threat in the client computing. I think if I was Intel and I was like, what am I going to worry about now? I would be more worried about the new Ryzen chips and what AMD is doing in both the client and the data center than I would be about what Apple's doing in terms of vertically integrating its own product sets here. I'm really struggling to make this any more news than it is, but at the same time, it requires the address because people are going crazy. Like, this is going to be a really big deal, and Intel needs to be really worried. People, take a minute, look at Intel's books, look at how Intel is performing, and look at where its growth and revenue is coming from. Look at where its big wins and profits have been over the last several quarters. And by the way, Intel just came off one of its best quarters in its history. So, you know what? When Intel lost Apple on the modem side, it was the best thing that happened to Intel because all that part of the business was doing was dragging resources down, and Intel was not in the mobile space. Let Qualcomm do that. That's Qualcomm's thing, and Qualcomm's very good at it. And by the way, a year later, Intel, the Intel acquisition by Apple is still not being used in the phones. Qualcomm's still going to have to supply the chips. And if Apple has any hopes of getting a 5G chip out in its new iPhones, and it will, and we'll probably hear about it next week, it's going to be a Qualcomm chip. So it's going to take some time, and obviously adding all the things that you mentioned, Pat. I'm just not worried about it for Intel. I wrote that piece, and I'm going to write another piece about that too in a big tier 1 journal that'll be out next week. So I'll put that in the show notes at some point.
Yeah, it sounds good. Yeah, Intel definitely has diversified their business. And to be honest with you, talking to suppliers of Apple, while it might sting at first, we see where many Apple suppliers have ended up, and that's basically the garbage bin, or Apple trying to take them over or steal their engineers. So,
by the way, that's a great point, because I didn't even go there, but
I did.
But Apple is like in tech, the Walmart in terms of vendor relations.
Yeah.
You want to work with them because the logo is great for your brand and your equity. But at the same time, they tend to really take vendors and chew them up and spit them out. And Intel's a little bit too big for that. But like I said, in a year, let's come back to this. I bet you were right. I bet you Intel's better off for it.
Man, I can't wait to see how Intel reacts too. Like putting all that MDF, and what are they going to do to position the Windows guys against the Macs? But this is going to be the hallmark story, the gift that keeps on giving, Daniel. So we will be there with real-time analysis.
I'm in.
Let's move on to the next one. And this is a partnership between AWS and Slack. And Daniel, I know you've done a lot of analysis on this. In fact, you published a research note on your website.
Yeah, I did, Pat. And given that both of us track AWS very closely, Slack had a bad earnings call, and we didn't cover it here. And, I think you and I were both like taking a breather to have a week where we don't have to talk about earnings. But I will touch on this really briefly. 1 Zoom, 0 Slack. Slack grew a little bit, but Zoom grew so much that Slack paled in comparison, pulled its guidance, and people were really worried. But guess what? Here's a score for Slack. Getting AWS, the world's largest IaaS provider, to basically come out, make a public press release and saying that we're committed to embedding our technology in Slack to support, the growth of Slack as a more complete collaboration platform. The work from home boom, the Zoom boom, has benefited companies that could offer a complete portfolio of collaboration. That is Zoom. That is Microsoft Teams. That is Cisco WebEx Teams. And that has not been Slack. And so by Slack being able to partner with AWS, build in, an SDK that natively allows the connection between these two services to create a more complete environment. Because here's the thing to remember, Pat, people like Slack. People that use Slack like Slack. But Slack, unlike Zoom, has not been able to get those high-paying enterprise customers at scale to deliver what the street's looking for. So basically putting this inside is a tremendous opportunity and a really big PR win for a company that really needed it right now. And I'm going to end with one last thought. About 2 weeks ago, I told Business Insider that Slack would be acquired by AWS. It was a bet. I said it. I'm not sure, but they asked me who could be bought. Well, the one area AWS has not necessarily shined has been on the SaaS side, on the software as a service. They've built some services. They use these services internally. A few customers pick these services up. But I could really imagine a Slack being an offering from AWS. I think that would just be explosive for the two companies. Will it happen? I don't know. This partnership would be a great preview opportunity for both AWS and Slack to see what it could look like. But it sure looks like the beginning of what could be a really good marriage.
That's really provocative, Daniel. And I hadn't even thought of that tie up. I to be honest with you, I was just happy for myself to figure out that no matter what deal gets done, AWS wins, because both Slack and Zoom and Chime all are on AWS. So they win, but I could totally see that. And if AWS were to acquire Slack, it would give them a better shot to have a frontal assault on Microsoft with Teams and integration. Because when I peel back the onion on Chime, it is very rich. In fact, I do 3 or 4 Chime calls a week. But the thing about it is we don't actually know we're using Chime, because Chime is really focused on APIs. So if you're doing a teledoc, there's a pretty good chance that either Chime or another service called Video, VIDYO, will be in there. But what they haven't done is an aggressive marketing out for a end user type of service. But really good analysis there, Daniel.
Thanks, buddy.
So let's move on to our next topic, and that is an Austin-based company, National Instruments, acquired big data company Optimal Plus. So a little background for our listeners: what is National Instruments? So all the chips and all of the hardware, all of the self-driving cars, all of the airplanes require engineers, and engineers require tools. The company that makes most of those tools is a company, test and measurement tools, is called National Instruments. And those software tools are software defined. Now, what's happened is in the world of IoT, their tools are now able to capture all of this data for the end product. So National Instruments acquired a company called Optimal Plus, who is in the business of monetizing that IoT data, and specifically for automotive, semiconductor, and electronics. So, for instance, the data that self-driving cars throw off, how do you manage that data, and what do you do with that? So, I see a tremendous amount of synergy here. In fact, I think in 2 hours, I'm actually talking to the CEO, Eric Starkloff, for the first time after he assumed his role, and I'm probably going to be asking him more about that. But for a company that flies so far under the radar, that companies like Tesla, Intel, Qualcomm, AMD, AWS rely on, I think this is huge. And Daniel, I know you didn't drill into this specifically, but you know a heck of a lot about big data and digital transformation, and companies using all of that new IoT data and creating more value with it.
Yeah, listen, this is also a very straightforward win. Data is the next oil. We've heard this for the better part of the last 10 years. And a company like National Instruments, which is essentially in the test systems, is going to be able to leverage data to optimize its work in every different vertical that it serves. It serves a number of key verticals. More data means greater accuracy. That greater accuracy can be achieved not only through the collection of data, but now putting AI, ML to the tests, optimizing the information that's providing back to all those vendors that you just mentioned, and then delivering a higher quality of service. So it's pretty straightforward. It's a big ticket for a company of National Instruments size. So we will be interested to watch sort of how this pans out, how it's applied. But the theory behind it is sound. A company like NI needs to be taking these kinds of risks, diversifying its business, leveraging a more analytical approach, given that accuracy is its business, and data and accuracy are one and the same in so many ways.
Yeah, I definitely urge you to do the double click, Daniel, if you have time. They're in rockets that SpaceX and NASA have shot up, and they had one of the most motivational speakers at their last NI week. They're really a genuine company. They haven't done a lot of marketing lately, but I'm expecting some big things from them as they transform their business. So Daniel, let's move to the last topic, and that is Pure Storage Accelerate. And I'm going to talk a little bit about the show, but I also got a chance to talk to Pure Storage CEO Charlie Giancarlo, who's just a great guy. So first off, on the last show, Daniel and I think we did Pure earnings. And Pure was the only storage company that had growth other than IBM, who in storage, IBM's win was closely aligned with its mainframe business and the Z15. But Pure was just rocking it. And today they had their big event. And essentially, they made a big announcement. And my storage analyst, Steve McDowell, wrote a great piece, but let me try to paraphrase it. So there's a lot of different storage out there. There's different file formats. There are different places it can be. It can be on-prem. It can be hybrid. It can be cloud. It can be multi-cloud. And these announcements just brought it all together. And it really unified storage. So FlashBlade unifies file and object store. Cloud Block Store unifies the on-prem to cloud experience. And Pure as a Service unifies the storage acquisitions that they've made. And the new file services unify block and file on FlashArray. And that might sound like a bunch of gobbledygook if you're not into data and storage, but it really is a big deal. And I think we saw the impact of that in what NetApp showed, what Dell showed with storage in the last earnings. Super impressive. Let me hit real quick on some of the things with Giancarlo. I'm going to write up an article on Forbes, but really what I wanted to know is hey, Giancarlo, how do you keep the plate spinning? You're not a startup anymore, but you're not a massive company. And he was very clear. It's all about customer sat, NPS, and the experience. And even though he acknowledged that their NPS had taken a little bit of a decline, it's still well above anybody else in storage and anybody else in infrastructure. And he talked about the markets that he'd like to get into in the future and how he approaches it. The funniest thing, though, was him talking about how he manages his people. And because a lot of the times at a startup, you have a certain kind of person, and then you move to a larger company and you need a different types of set of people. And he called this the pirates to Navy process. And, you come out as pirates and it's a whole different, kind of like you and I, Daniel, we're still pirates. Okay. We're not the Navy. We're not the 1,000-person organization with multiple layers. But when you get there, you do have to transform in the way that you do that. And he feels like he can keep even the pirates because they're excited about not only servicing and doing awesome things for their customers, but also raising the stock price. Because when you look back and look at where they opened back in, I think 2015 and where they are today, it's not that big of a growth. So fascinating. I can't wait for you to meet him.
Yeah, no, it sounds like a really good discussion. I haven't been tracking the event closely. Pure's a company that sits on the periphery of my radar, but over time, I've been watching more closely. The story and narrative around the company's net promoter score, focus on customer experience, has always grabbed my attention. In a sea of tremendously successful big tech companies, IBMs, Dells, HPEs, Cisco's, that just to name a few. And then, of course, you've got hyperscalers all offering and deploying their own versions of storage offerings. A company like Pure has to differentiate. And it started off differentiating, around cloud. But in the long run, it's going to be around experience. That's the chance it has. The specific focuses, remember early in the show, we talked about the vertical focus of IBM. How do you differentiate? When you're a little bit smaller, you have to know, what do we lean into to become successful? What are the things that we can do better, faster, be more agile, be more committed? And for this company, it's clearly been this NPS. Now, the company should put its antenna up when it starts to see that number drop, because that's a leading indicator of the company's biggest opportunity. It's always been. It's a bellwether. So if that's falling, I think it sounds like Charlie needs to really do a quick scan of the organization, get his leadership in place, implore them to figure out what's happening, Why is there a loss in terms of that score? How do you get it back up? Is that raises? That's the best chance with that rising. That's the best chance of garnering more market share, garnering the growth that's going to be required to take the company's profits up, bring it to a profitable level, and then ultimately get that stock price up, which is everything that Charlie needs to be thinking about from the minute he wakes up in the morning to the last time the last words before he goes to sleep at night.
Yeah, the last impression that I got is, first of all, even the rank and file, they moved a higher percentage of their compensation to NPS. So that gets people's attention even more, even if they've been dedicated to that. So Daniel, good analysis here, my friend, but we are at the end of the show here. If you liked what you heard, and even if you didn't like a few things that Daniel said or I said, press that subscribe button, and we will be back next week with more analysis on the biggest tech news. Daniel, are you headed anywhere next week? You know, usually we start out talking about that, but that gets a little old when we're not going anywhere.
Yeah, I'm glad we didn't do that this time. I think we're boring our audience. And yeah, if anything Pat said really sets you back, still hit that subscribe button, because we do appreciate you. And I promise you, we're gonna have a lot of fun. We're gonna be honest. We're gonna pick a little bit like like Mike and Mike in the Morning, or any of those good talk shows. If we're too nice, too cordial, and too agreeable, I mean, what the heck? Why even do this? The analysis runs deep. And Pat, I want to give you and I a little credit right now. We actually did the 6x5 in a legitimate 6x5, 30 minutes of analysis, plus or minus the introduction. So for everyone that's listened to our last few episodes where we've run long, and it's because we have a lot to say and there's a lot to analyze. But this, Pat, we get 5 points, 6 points, 6 points, 6x5. Appreciate everyone out there. Thank you all so much for tuning in today.